Our market monitor tonight has names of stocks that he says will remain valuable even with rising trade restrictions between the U.S. and China. This is his first time on our program. We welcome Jeremy Bryan. He's portfolio manager with Gradient Investments. Jeremy, good to see you. Thanks for joining us tonight.
Thanks for having me.
I'm going to jump right in with your first pick. I'm curious. It's Starbucks. You say it should do okay even if there are trade tensions between the U.S. and China. But Starbucks is making a huge investment in China. Make your case.
Yeah, so the case is just a little bit of a different story with regard to Chinese expansion, and that's brand expansion. We think that Starbucks, the brand over there, there's still a demand for Western brands in China, in the Chinese region, and we think that Starbucks is one of the predominant sources of that. We think that they're going to continue to grow in China from a units perspective, from a sales perspective, but also the U.S. side, we could see a reacceleration as well. So you get the double whammy of growth in Starbucks.
So you don't fear any kind of retaliation by the Chinese government could hurt Starbucks?
It could in the very short to interim term, but I still think over a longer period of time, I still think the brand expansion, the brand opportunity of Starbucks is too big, and it's still too in demand to be affected by that over a long period of time.
Okay. Chevron, you're making a bet on oil and you love that dividend. Who doesn't love 4%, huh?
That's exactly right. I mean, if you look at Chevron, the interesting part of Chevron is it's back to basically about November 2016 levels. If you look at oil prices during that time, oil prices were in the low 50s then, and they're in the mid 60s now. And Chevron's at the same price. So you get that dividend yield, which, like you said, is over 4%. And then also, I think you've got some free cash flow opportunity to where they can increase that dividend and also do some share buyback going in the future. Finally,
you have Celgene. I know it has suffered, this biotech company. Is this a value play? Is that how you see it then?
Yeah, so it can be a pretty long fall from growth to value, which Celgene's kind of been through. And the funny story is we bought this today, and we think we're there. That's the thought. I mean, Celgene was at 147 about 6 months ago. It's about 85 now. And so we're still looking at a company that can do 10 to 15% EPS growth over the next few years. If they even get one of their drugs to come through and into that pipeline, this could be, a double stock in the next 2 to 3 years.
But it is a good highlight that biotech can be very, very volatile, right?
Absolutely. You have to be cognizant of that. And that's why we prefer to buy them when they're at these price levels where upside is a large potential, both from the EPS growth and the valuation opportunity.
Jeremy Bryan with Gradient Investments. Again, welcome. Thanks for joining us tonight.
Thank you very much.